What's up? What's up, everybody? Welcome aboard. It is Tuesday. It is the 19th of September. This is Trading with Bubba, or the Bubba Show, whatever you want to call it. And, well, I don't know. I think as I wrote in my update and said in my update this morning, this could get ugly. And here you go. I mean, we peaked at resistance. Now we're going to come down. I would suspect we're going to test support possibly today. Okay, it'd be a pretty hard sell, but it might get there today in the S&P, the Nasdaq, same thing. Looks like it's going to test support. The Dow breaking down through support, maybe going to the next support. So another 300 points lower in the Dow. And again, this selling has the potential to really accelerate. Now, one of the things that's lacking in the selling is the VIX, which isn't going up as fast as you might think. So you would call this selling fairly orderly. Okay, you would call it fairly orderly, but I think the markets are in trouble here. Again, I'm not telling you to do anything, and just full disclosure, my personal positions that I've been carrying every night right now are short everything but the Nasdaq. Okay, but that could change as well. And I'm just trading the trend, and that's all I'm really doing. And those things, but day trading is a different story. And of course, we had some activity this morning in our day trading, and we've had some pretty good activity for us. When I'm with you, we've actually made some dough trading as well. But markets have gone quiet once again, as you see all the volume drying up once again. Now again, we can see it'll come back. We do have the Fed tomorrow, so that could create some action. We'll see. Again, I don't make predictions other than I can tell you that it looks kind of ugly right now, and we'll see where we go. Crude looks great, like it wants to go to the moon. That's the big picture that of course your government has done for you. They've made crude go to the moon. This is the highest price crude has ever been at this time of the year. Okay, and of course it's all for tax money, because of the excise tax on crude oil, right? But anyways, I thought maybe today we talk a little bit about, a brief overview on a trading plan, and putting a simple plan together. Now I've got much more extensive PowerPoints on this, but a trading plan, you have to have a plan when you're trading. You have to have objectives, you've got to have goals, and the goals that you set need to be reasonable goals. I mean, if you say that you got a $5,000 account, you want to make $100,000 this year, you're out of your mind. Okay, I mean, could it happen? Yeah, it's possible, but that is not what you should expect, and that should not be your goal. That would be what we would call unattainable. Okay, goals need to be attainable so that you can reward yourself when you get to the point where you reach a goal. But you got to build a plan in it, and the plans including what type of style you're going to trade. Now, if you're going to trade more than one style, as I do, then everything that you do has to have a separate trading plan. Okay, and everything has to have a separate exit plan. I know day trading, when I'm using this stuff, okay, I know exactly of each product where my exit's going to be if I enter. If a trade gets triggered, I know where I'm getting out. Okay, but again, they don't always get triggered, but I do know, and I will be prepared for that at all times. So again, it's the components are your entries. Okay, now, and why are you entering? Okay, anytime you enter a trade, why are you entering a trade? Okay, are you entering on a, like for example, I've shown you and shared with you the blow-off pattern, which we don't have any happening right now, so I can't really show you. But of course, this was a blow-off here, okay? And you can see about where the volume stands out. But are you looking at charts? What are you doing to give you an entry? What is your risk? Okay. Now your risk has to be commensurate with your bankroll. Okay, the amount of money that you're trading with. Okay, if you've got a $5,000 account, you cannot be taking $1,000 risk on a trade. Your normal risk should be under 5% on any trade that you make of your overall account. Okay. And it probably, the better number is probably 2 to 3%. Okay. And then your exits and your profit target. Now, I don't set profit targets myself. That's part of my plan. I try to let trades run as far as they can, but I will manage them by moving my stops up. Okay. And I'll get to a point. So basically, for me, every trade that I make in the futures market, I get stopped out. But again, stopped out doesn't mean bad. It's a lot like this morning. I got stopped out of a trade with 100 ticks profit. Okay. But I didn't want to try to pick a profit target. I wanted to let it continue to run. But these are the very key ingredients. Okay. Because you have to always know if this, then that. Right. So I'm already planning. Like if I know a trade is getting about to trigger, we'll go to the shortest trading plan. So if I'm looking at right now, is there anything that's really happening? No. Okay. But let's make an assumption that crude oil is going to rally hard, the volume's going to pop, and I'm going to be a seller. Okay. And this is just, we're making an assumption. If we get a real example, I will do the real example, but I'm not making this trade. But if I were to sell it, again, so now I know that if this is my entry somewhere around here, my stop is going to be in crude oil 60 ticks above the top of this bar. So right now, my stop in crude oil, if I were entering a trade here, would be 92.51. That's automatic. I already know that because I'm already looking ahead of time. So I know the if and the then, and I'm always being prepared for the if and the then. Because again, part of being successful in markets is setting yourself up, knowing that, hey, sometimes you're going to catch a bad break. Sometimes the market's going to go, it's going to take you out and stop you out and then go exactly the way you thought it was going to go. And I will tell you that my record is 7 seconds, okay, of getting stopped out. But at the end of the day, remember, it's more, the business is more about money management. The business is more about making sure that you retain your capital so that you are never putting yourself out of business. Okay, that is the importance of what we do in this world. Okay, so we always have to be prepared. And again, as I'm telling you now, if you've never experienced it, you will. There's going to be, as they call them, bad beats. If you've ever gambled, you know, for example, if you're a gambler and you bet on the San Francisco Ram game on Sunday, why the guy kicks the field goal at the end of the game is no idea, but it covers the point spread. Okay, for no reason. But again, that's going to happen. And the sooner that you recognize that bad things are going to happen, but also that you know that if you're prepared and your preparation, okay, then it becomes automatic. It becomes a non-emotional event. It becomes a simple matter of fact event. And that is something that you always have to recognize and remember as well. Okay. Trade the market, not the money. And again, are you willing to lose money on a trade? If not, don't take it. You can only win if you're not afraid to lose, and you can only do that if you'll truly accept the risks in front of you. And what does that mean? It means, look, when I was trading on the floor, there were guys that might have lost money 1 or 2 days a year, but that doesn't mean they didn't have losing days, losing trades within that. But what that also means is if you're not willing to accept risk, you're not willing to make as much money as you can either. Okay. You know, when you're in a risk business, you have to take risks. Now, again, I'm not telling you to take risks without thought. I'm not telling you that just because you trade more actively, it makes you a winner. But if you have reason to trade, like right now, again, if I were trading, if we weren't together right now and I were sitting here watching, okay, I have nothing to do right at the moment. Okay. There's no trade for me to make right now. Okay. So I already know I'm not doing anything. But if suddenly 5 or 6 trades pop up, I'm going to take them all. Okay. Because I'm not afraid of the risk. Okay. And that's what you have to understand, is that the business that we are in is a risk business. Okay. The only true real money is made when you're willing to take risk. But the risk has to go back to what? You have to go back to your plan. Okay. So that you are prepared for the risk that you're going to take. And you're prepared to get out should you need to get out. Okay. These are things that people don't think about. They don't talk about. Everybody promises you how rich they're going to make you when they're going to take all your money away and you're not going to make anything. Okay. You have to understand for yourself, what am I going to do? How am I going to get in? How am I going to get out? And the most important part is the getting out. Okay. If you remember the Raid commercial, the Roach Motel, you get in, but you can't get out. Well, if you're trading stuff that's not liquid, you can get in, but you can't get out. And you better make sure that when you're trading, that you have an exit plan that allows you to get out. Okay. Even if it's at a loss. Again, every trade is not going to be a winner. Okay. Things happen. They go against you for whatever reason. You can do the most perfect work, which then takes us to what's another part of your trading plan. You need to keep a journal. Okay. And your journal, if you're trading more than one system, you have to have more than one journal. Because again, I trade day trade 4 minutes. I trade swing trade options. I swing trade futures. Okay. I carry investment positions. So I've got plans for all of those. Okay. And I've got journals for all of those because each one is different. Everything that I do is different. But it comes down to, are you willing to take risk? Because that's what the business is about. It's about risk. Okay. It's the reason that you trade is because you want to make more money than you can make somewhere else. Okay. But you can't get there unless you're willing to take a little bit of risk to do so. Okay. Trade what's happening, not what you think is going to happen. Okay. And what does that mean? It means quit trying to guess what the market's going to do. Okay. I told you that I thought the markets could get ugly. But does that mean that I have a position based on that this is going to get ugly? No. In fact, I've got my normal positions on, which I carry every day. Okay. Whether they be long or short. And my day trading, which is what I'm watching here, I've got no position right now. I've got zero. Okay. Why? Because there's nothing to do. Okay. So why should I have a position on? And so again, just because I want to take risk and want to be active doesn't mean that there's a trade for me to make when I want to make it. So if I start influxing in my opinion in the market, I can only put myself into a bad position. You must learn to read the footprint of the market, okay, and the direction of what the market's telling you. And for example, crude is spiking up to resistance right now. Now, again, I don't necessarily want to be short crude here. I could not, with good conscience, be a buyer as it approaches resistance, but I'm certainly not a seller. The trend is clearly higher. It is clearly running higher, and there is no reason for me to suspect otherwise. No matter what I think, okay, the market is telling me exactly what it's going to do. Okay, so again, right now, if I'm looking here, I know that I don't want to be a buyer yet, although I already am long, but I don't want to be a buyer now because I'm at resistance. Okay, I would prefer to see a pullback, okay, or a breakout and then a pullback to support. Right? But I've already got that in my plan. My plan is already made. So I go back to here because this is what I'm really watching if I'm looking to be active. And right now I have nothing to do because there's nothing that's really moving right now that's giving me enough volume. And again, that's part of this plan. All right. And some of my plans are minute by minute, which would qualify here. And some are day by day. Okay. I don't make in my long-term positions. Okay. And right now, if we look, okay, my overall positions, I would be long the dollar. Okay. I'm short the euro currency. I'm short Bitcoin. I'm short bonds. I'm short notes. I'm long gold. I'm short silver. I'm short copper. I'm long corn. I'm short beans. I'm short wheat. Okay. And so on. Okay. Those aren't, I'm not adjusting those to say no matter what. Those will get, if there's an adjustment to be made, it will be made tomorrow. Okay. Some of it will be made in the overnight markets, and the markets that are not open overnight will be made when the markets reopen. But I do not get caught up in my position trading in the volatility, okay, in the intraday action, okay. So quit trying to guess, okay, because losers average losers. Quit being exceptional. Averages quit or be exceptional. Averages for losers. If you try to average into trades, now again, we will average into some trades, okay, but not really averaging in. If I'm playing the particular pattern that we talk about, which is the blow-off pattern, which I've shared with you, okay, then, like, for example, I give you the perfect example. This morning, when we were trading crude oil, okay, we got in and we got short, okay, and got stuck. It didn't stop us out, and we got another entry that came because it was an entry, not because it was my opinion. It came because the entry showed up, so it gave me a reason to go ahead and add to that, and I actually had a double position on it at that time, okay, and that is something that we want to make sure that we focus on, okay. Again, we don't average because we look at value. We average because there's a reason to average, okay. So quit or be an exceptional trader. And again, exception doesn't mean that you always make money either. Remember, there is no guarantee that you always make money. And I'm going to step out here for a quick break, and I'll be right back because I see my man Max is there, so he can take me out for a second. I'll be right back after this short break. What's up? I'm back. And of course, the stop loss part of your trade needs to be mathematical. It needs to be outside of the range, okay, of where the markets have been, which is how I show you, okay, and share with you that, every trade I make is going to be X amount of ticks above or below the high or the low of that market. So if I'm getting long, my stop is going to be below X amount of ticks below the low of that trade, okay? And you'll find that mathematically that works very good and keeps you in markets a lot longer, and good stops are better than good trades, okay? So you want to remember all those little things that will help you, okay, as you move on, because our biggest thing is, what do we want to do? We want to avoid the disaster, okay? That's our whole part of our plan, right? We don't want to get into a position. Too many people over the years have gotten into a position that's gotten them destroyed. In fact, I'll go back, I don't know, it's about 7 or 8 years now, but there was a company called optionsellers.com that everybody told me it was the greatest thing ever and that I needed to get involved. And I said, if you get involved, I am throwing you out of my program because you're going to get killed and you're going to lose all your money. And of course, what do you think happened? Okay. They made money, then they got killed, they lost all their money. And still today, they're paying back the debt that they created from that program. Okay. You have to have everything to avoid the disaster. So if you're trading options and you're selling premium, then you should be selling spreads, not naked premium. There is no edge to naked premium. In fact, I can make the case that the naked premium is at a disadvantage because of the margin you're consuming, because of the margin rate that you're paying, and the tying up of your capital, versus creating a similar trade but using a spread, which then reduces the capital using, reduces the risk, and reduces the margin requirements. So again, you can argue with me all you want, but I will tell you that I'm right. Okay. And, as we look at, you got to assess who you are. Okay. Because, if your skill set is as a beginner, well, then you probably need to be more focused in on trading one thing first and master that. Okay. Versus if you're an expert, and I'm not going to say that I'm an expert, but I'm capable of trading. I mean, I watch 30 futures markets at one time. Okay. So I'm trading with my members 8 at one time. Okay. So, but again, I will always tell everybody that you don't need to do all that trading, and you need to be comfortable, because again, remember how emotional we get about money. Okay. And money's an emotional topic. It ruins friendships, marriages, and people. Okay. So money is very important. So you have to make sure that you assess your skill level. Okay. And then B, you trade to your skill. In sports that have no risk of dollars, it's always better to play above your skill level to get better. In trading, you don't need to do that. Okay. Because here it's a matter of not only developing your overall skill level, but developing the way that you trade and what you're going to do and what your plan is going to be, versus that you're trying to get better, against others. Here you want to get better against yourself. Although we are in a competitive business, because of the setups and the way things are now, we just trade. So we have to make sure that we understand the positions that we're putting on, the risks that we're taking. When you use a margin to create an option spread, does the brokerage charge you interest the same way when you use? Yeah, oh yeah, they charge 9.5% right now. Okay, interest is high, which is another reason why everybody talks about selling puts, for example, naked puts, because I want to buy this like anyways. Well, that's fine, but if I want to sell a naked put in Apple, here, let's just do the example, as long as you asked. Okay, so I'm going to go to Apple. Okay, Apple. Okay, and I want to sell. Let's say I'll sell a put for next week. Okay, next week. So let's say I'll sell the 170 put. Okay, it doesn't matter. I'll sell the 170 put. So I'm going to sell the 170 put. I'm going to make a collection of 60 cents. Okay. All right. So now for that 60 cents, what is my risk? Okay. Well, my risk is, in theory, $17,000 minus 60 bucks. Okay. But now this way, my margin requirement on this stock is what? Okay. Is $17,000, versus if I add in and turn this into a spread. Okay. And I can make this 20, right? So I'm getting about the same amount of credit. Oops. I'm getting about the same amount of credit, but now my margin requirement is only 2,000 instead of 17,000. So you tell me, 9.5% on 2,000 or 9.5% on 17,000, which is better? Plus the fact that my maximum risk is only 2,000, that's 53 cents. Your maximum risk is, in theory, 17,000 minus 60 cents. What's a better trade? Okay. So again, it goes through the entire market structure. It's about putting yourself in the best position at all times as well. Okay. And that is, again, what we're watching. I mean, listen, the mental preparation that we take in trading, remember, you are your own worst enemy. Okay. We as individuals are our own worst enemy, because we do dumb things. All of us, not just you, not just me, all of us. I mean, it's an emotional business, right? And if markets are flying around, you can get very emotional. Okay. Well, again, it doesn't do you any good. Okay. So you need to look in the mirror and recognize who your worst enemy is, which is that person that's looking back at you. That's your enemy. Okay. And you have to try to, again, it's not easy, but it's something that you have to work on, because we all have the same tendencies. It's just like when you see these major market panics. everybody's selling at the same time. You hear often, excuse me, if you listen to the networks, okay, which I don't, but if you listen to the networks, you often hear about the high frequency trading. Okay, that's all false. Okay, high frequency trading is nothing more than an electronic market maker, which replaced my job. Okay, and they're trading billions of shares or billions of contracts for fractions of a penny. They don't care which way the markets go. They just want to scalp it out. It's automatic. The real high frequency traders are you, individuals. When everybody panics at the same time, everybody chases at the same time. That's what creates the big moves, not the high frequency markets, not the algorithm traders. Okay, it's the individuals, because you have to remember that in today's world, okay, everybody's got access to trade the market, whether from their iPhone, from their car, from their home, from the beach, from the pool, from the golf course. So everybody's panicking at the same time. What do you think is going to happen? Okay, think about it. Okay, I'm going back to my chart. Put me back there. Give me over there. Anyway, it's mental preparation. Okay, the goal setting. We talked about it, right? Well, goals are set based on what you're doing. Okay, and I will warn you about goals that are too short term. Okay, goals are great, but those who say I want to make a couple $100 a day, it's a good goal, but it's really not that. It's not that achievable. Okay, because there's going to be bad days. Better you say, I want to make 5% this month. I want to make 3% this month, because you have to give yourself time to realize your goal without putting yourself in pressure. So they're specific, they're measurable, they're achievable, they're realistic. Okay, all those things come into play. Okay, because that's what we have to make sure that we're focusing on. And of course, I talked about journals and your homework. A big part of doing your trading is also doing your study, doing your preparation for markets. There's plenty of time, and this is not supposed to be meant to be a full-time career that you're always studying every night, like going to get a college degree. But there's always times that are slow in the market that you have an opportunity to refresh your memory, to go back through either an old recording, go back through some of your old notes, okay, update your journal, because doing like a post-mortem on trades that you have made, you'll find out, did you make a good trade that just happened to go bad? Did you make a bad trade that happened to go good? Or did you do what you're supposed to do? Okay, and this is what we talk about. But the markets are always ever evolving. Things are always changing. Okay, and you as the individual have to be prepared to change with it. In fact, tonight I do every quarter I do a hedging class. I teach people how to hedge their equity portfolio. Okay, and it's an expensive class, but people love it, and they do good, and they can protect their long-term assets. Okay, but again, I've taught this class for 12 years, so I've probably taught it a couple hundred times, and almost every time it's different, because even though the basics are the same, the market conditions are almost always different, invariably different. So even though I'm teaching the same philosophy, there are things that are going to happen. Like right now, a hedge today is much less expensive than it was 6 months ago, and probably less expensive than it will be 6 months from now, because volatility is so low. And if you understand what implied volatility is, okay, which is another problem, you have to know not the Greek terms. Okay, I'm not a Greek guy, right? I don't give a shit about delta, beta, vega, theta, rho. To me, it doesn't mean anything. Okay, I know that the delta, the at the money option is 50. Okay, but I don't need to know that it's delta. I know that time decay is time decay, but what you do have to know is what value is and what expectations are. Okay, because if you subscribe to the theory, which is factual, options are always fairly priced, except when they're expensive. Okay, they're never cheap. You hear again. I'll refer back to the TV set. they always say, well, buy some cheap protection. There's nothing cheap. If volatility is falling and options are inexpensive, that means that nobody's expecting anything to happen. And more likely you're going to lose your money. Okay. Because we don't like when volatility is too low. We want that middle of the area where there's some action back and forth, because two-way trade is the key. But as I go back to the hedge, sometimes our back ratio hedge will be $600. Sometimes it'll be $1,800. Okay. And anywhere in between. So every time I teach the class, it's a little bit different. Okay. Now again, it's the same base ideas, but with markets changing. And of course, since I started teaching the class, we went from quarterly and monthly options to weekly and now some daily. So that's changed, right? So again, being prepared for what the markets are offering you are the next part that you have to make sure you're doing. Okay. But it's about studying. And again, like I said, you're not going for your master's. Okay. You're not writing a thesis, but you should do some studying and have some idea of what you're going to do so that you are indeed protected for yourself and against yourself. Okay. For yourself and against yourself. That's very, very important for what you do. Trade preparation. Again, you have to decide, the trade that you're making. Oops. Let me switch over here before Max yells at me. Okay. Trading versus investing. You got to make sure that you understand. Are you putting on a trade or are you investing in something? Do not mix the two. When you mix the two, you are creating an issue and a problem for yourself. Okay. There's many times I've seen it happen before. Someone will take and buy two stocks. One is an investment, one is a trade. And of course, the investment goes up right away and, I'll take the profit. And the trade goes down. I'm not going to honor my stop. I'll put it into an investment. And of course, the investment that they meant as an investment, they turned into a trade, is still going in their favor and they're out. And the trade, which was meant to have a stop and be out of, is still going down. So how did they do overall? Okay. Again, you think that this is all ridiculous. This is stuff that's going to make the difference on whether you become a successful trader or you become a failure. Okay. This is what this business is about. Okay. It's about recognizing exactly what you're doing. And then we got exit rules. Okay. And again, we talked a little bit about that earlier. What are your exits? Well, in my hedging model, my investing model, everything is automatic. In fact, it's all automated through Tradier. Okay. I've got software through Tradier that we've written. So everything, I don't have to make any decision there. I've already made those decisions and those are automated. But in my regular trading, okay, if I'm making an options trade, the trade itself is designed, okay, and built with a built-in stop to begin with, because it is some sort of a spread that I have put together to create that trade, okay? And that trade has a limited amount of risk when I put it on. And, a common trade that I will use, if I want to go directional and I want to go strong directional. So if I think Apple's going lower, okay, so I would sell a risk reversal, okay, sell a collar into the combo, okay, and then of course I need to protect myself from an explosion to the upside. So I'm going to buy a call above. So really what I've done here is I've sold the call spread, okay, and I bought the put, and I bought it for 36 cents, okay, versus, okay, if I just bought the 177.50 put, I'd have to pay, okay, $2.29. I'm doing it for 32 cents, the same trade, okay. Now my risk is a little bit higher if it goes crazy against me, but my profit is much bigger if it goes for me, okay. And I'm not taking the same risk that you're taking initially. I have no exposure to time decay with this trade that I'm putting on here, okay. So again, I already know, because I've built these trades and I built them to be prepared to whatever I want to do. Sometimes I use a straight calendar or a weighted double diagonal, which we'll cover more on Thursday. But again, the trades that you're looking at and you're trying to do, you have to figure out how to put the best trade on for yourself based on your capital, based on your personality, and based on what you're doing. And finally, for today, okay, you are constantly analyzing your performance. Okay. And again, not because we want it to be good or bad, it's because we have to recognize where we are. Okay. And are we improving on our trade? Okay. And these are things that we always want to make sure that we understand, is that our performance is very important, because obviously you're here to make money. Okay. So we don't analyze our performance and we don't know how we're doing, or don't know how we're standing, or don't know what we're understanding. It means we got to go back to basics once again. Again, I'm trading for 44 years. This is my 45th year as a trader. Okay. And I'm still trying to learn things. I'm still trying to learn a better way to build the mousetrap, because there's things that I find out as I practice, and as I look, and as I study, that make me better. Okay. And I still make mistakes. Again, and I still do dumb things. Again, you don't grow out of mistakes. Okay. But you have to learn from your mistakes. Know they're going to happen. Know you're going to do it, but try not to do it again. Try not to repeat the same mistakes over and over again. Okay. Find new ones to make. Right. But that comes from experimentation. Remember, you can build in the optional world, in the derivatives world, you can build all kinds of products. Okay. You can create all kinds of positions. Just remember that when you build something, make sure that you know what the risk is on that trade, and don't get yourself trapped in a trade that has open-ended risk that you cannot defend about. Okay. It's just like, if you are familiar with the term calendars, you can never, or you should never, okay, sell calendars, because if you're selling calendars, it means you're buying this week's expiration and selling next week's expiration. You have no defense. Okay. The long option that you own will not defend you against a spike in volatility. It will not defend you in most cases, and most brokers won't let you put it on. Okay. But again, you always want to own options behind where you're short options. Okay. When you sell the ones behind, the ones you buy don't protect you. They may help you. It may help you a little bit, but they don't protect you. And what they really don't protect you against is a major volatility expansion. Because remember, as the options you own that are expiring this Friday, for example, they're not as affected by volatility as the ones you might be short a week, 2 or 3 weeks out. Okay. So keep that in mind. And again, I urge you to continue to study. I urge you to continue to look at charts and focus on the footprints that the market's leaving. Like, for example, right now, it looks like there might be a little bit of a blow-up activity in the 10-year notes potentially. Okay. Again, I'm not going to make the trade now, because I might make it for myself, but I'm not going to make it with you, because I'm not going to be here to manage it for everybody. And I hate to see somebody make a trade like that and get stuck. Okay. But it's certainly something. But again, always watching, always anticipating, always being ready for the next move in the market. Okay. And again, that still doesn't guarantee that next trade is going to be a winner, but consistency will help you guarantee profits and wins over time, even though there's going to be losses. And remember that, Tradier brokerage is by far the best because of the cost. Okay. I know they sponsor us, but their cost saves me $100,000 a year in commission. Okay. And subscribe down below. And in the meantime, Max, thanks so much, brother. I'm going to jump. Busy, got some things to do, but I'll be back on Thursday.